Welcome to Tax Talk. Today, it's all about S corporations. First, let's talk about some of the basics. Have you paid yourself a salary? As a person working in your own S corporation, you need to pay yourself a reasonable salary and issue yourself a W-2. What's reasonable? Well, nobody knows that answer better than you. It is contingent on your business and your work. So ultimately, you are the best person to decide what is reasonable. Make sure you've got your bookkeeping sorted. This is your revenue and your expenses, your gross revenue, your returns and allowances, your cost of goods sold and your services sold, salaries, depreciation, interest, rent, marketing, employee benefits, all of the expenses your S corporation incurred. For items like depreciation, make sure you stay abreast of changes. Bonus depreciation was 100% in 2022, but that changed to 80% in 2023 and will be reduced to 60% for 2024. Now, there may be some congressional action here, so stay alert for changes. Tax tip 1, have an accountable reimbursement plan. This plan is commonly overlooked. You are both an employee and a business owner. You're gonna have expenses that are both personal and business related. Think about your cell phone, your automobile, those things that are used both personally and professionally. Setting up an accountable plan allows you to be reimbursed by the corporation tax-free and allows the corporation to deduct the expense. So make sure you turn in receipts for these expenses. Tax tip 2, deducting your health insurance costs. As an employee, health insurance is normally paid for pre-tax, but when you own more than 2% of an S corporation, the health insurance costs are taxable on your W-2 and you deduct your self-employed health insurance on your 1040. It sounds simple enough, but there are many moving parts and several forms needed to get there. If someone is preparing your payroll forms, they should understand this, but you have to get them the information. Tax tip 3, retirement plan contributions. As an owner of an S corporation, you can establish a qualified retirement plan that allows for you as the employee and your S corporation as the employer to make contributions to your plan. For a 401k, if you contributed as an employee, you could have already put in a maximum of $22,500 for 2023, plus a catch-up if you're over age 50. This lowers your W-2 income. Employer contributions don't have to be made until your filing deadline, so that's March 15th, and they could be up to an additional 25% of your wages. Your total 401k contributions can be up to $73,500 if you're over age 50. Now, be cautious because whatever you set up for your employee match applies to all employees. So if you have other employees, you need to figure out what kind of match works. There's also SEPs and simple plans, and these are similar to the 401k, but they have different contribution limits and different participation rules that you need to consider. Our final tax tip, understand your qualified business income deduction, your QBI deduction. This is a deduction of up to 20% of your net business income, subject to certain AGI phase-out and phase-in limits. You'll need to know if you are a specified service trade or business, an SSTB. An SSTB is a business that relies on the professional reputation of its owners and employees. Think about your law firms, your accounting and consulting firms, or your performing arts and athletics. These businesses will phase completely out of a QBI deduction if they're over a certain AGI limit. For all other business owners, those non-SSTBs, there's a phased-in limit based on business property acquired and employee wages paid. Now, if you have multiple entities, there's some planning strategies that allow you to aggregate the business property acquired and the employee wage costs, which might result in a better QBI deduction. The QBI deduction is probably one of the more complex areas to understand, and implementing tax strategies to reimburse yourself or deduct your health insurance costs and contribute to your retirement plan may actually impact your QBI. But maximizing this deduction can materially reduce your taxable income. S corporations come with some great tax benefits, but it can also be difficult to navigate the complexity of the rules, and much of this should be done in coordination with your overall financial goals in mind. So if you have questions or you need help navigating your financial plan, take advantage of our complimentary tax analysis at Pure Financial Advisors.